Hello class. This video will cover the material from your financial accounting textbook, chapter 5, accounts receivables. Accounts receivables are a major asset to most businesses. So this account represents future cash inflow, typically generated from your business or company providing goods or services on account. So we have done some work for a client or we've given them a product and they have not paid us yet. You would have debited your accounts receivable, increasing your assets, and credited your revenue account, increasing your equity. So along with this, there are a few new accounts that we're going to learn. Most of them are called contras. 3 of them are contra revenues. The first 3 accounts you will learn in the text for this chapter are sales returns, sales allowances, and sales discounts. Sales returns are used whenever someone brings a product back, whether they were dissatisfied with it or the product was broken, they return it to you and you would debit the sales return or you would credit cash or accounts receivable. Sales allowance is used when a customer cannot bring a product back, so often used for service entities when someone is dissatisfied or would like a cheaper price on their service. So you would debit sales allowance and again either credit cash or accounts receivable. Sales discounts are used to entice your customer to pay their bill in a timely manner. You will see on the homework and in your textbook something like this, 2/10, net 30. The first number represents the percentage of discount, and the second number represents the days a customer has in order to utilize that discount. So I will display a journal entry of how you would reflect if someone owed you money, accounts receivables, and you had sent them a bill or an invoice. And at the bottom it said 2/10 in 30, and the customer paid within 10 days of that invoice date. If there is a bill sent out to your customer and if they pay within 10 days, I'll show a journal entry here now of what that would look like. You would take 2% off of their accounts receivable bill and post it as a debit into the sales discount. And then the rest of it you would receive in cash from your client as a debit. Then you would have to clear out the accounts receivable as a credit. So all of these 3 have normal debit balances. That's really important to remember. Normal debit balances, they are temporary accounts. They show up on the income statement. They reduce your total net revenue. So those are 3 new contra revenue accounts. So the latter part of the chapter and the second part of this video is going to cover the difference between the allowance method and the direct write-off method. We will focus in this class on the allowance method because it is part of our generally accepted accounting principles. It's considered more accurate and it follows the matching principle. So accounts receivable helped to generate an asset that is going to be future cash inflow, but really it was triggered by service revenue or product revenue. So that revenue has a related expense when people don't pay the amount they owed to us. So a cost of the business allowing their customers to have the product or the service without paying right away for it is going to generate what we call bad debt expense. And that is the account we use and debit at the end of the accounting period or the accounting cycle, the end of the month, quarter, or year, to reflect how much we think we will not collect and how much it is costing us to allow our customers to charge with us, to have an account with us that they are going to pay at a later time. So you estimate your bad debt expense each period, each month, quarter, or year, based on industry standards or your historical data of how much you typically don't collect on your accounts receivables. You are going to be shown in the textbook an aging method, or just a flat percentage rate is what we will stick with in your test questions. The aging method follows the theory that an older debt is more likely to not be collected, so a higher percentage of it would be uncollectible. So whenever you see those problems, the two methods we're referring to are the allowance method and the direct write-off method, but then there's also two different ways to how you come up with this amount. If I told you that we had accounts receivable balance of $20,000, but we estimate that 10% of that is not collectible, we would put $2,000 as a debit here to our bad debt expense, and we would credit the allowance for uncollectible. I'm kind of running out of room, but this account is a contra asset. It is going to decrease your overall, what we call net realizable value. It's a contra asset. It's also going to, on this journal entry, decrease your equity. The expenses, that E there is a part of your equity, a decrease to your equity and a decrease to your assets. This is a contra asset. And this is what we will record anytime we want to make an adjusting entry for bad debt expense. Now there's one other journal entry with the allowance method, and that will be your write-off entry. That is not the same thing as the direct write-off method. It's the entry that we record after some time has passed, maybe even into the next accounting cycle or the next year, and we finally decide a certain specific client's account needs to be written off, that they're deemed that we are not going to collect from them. Maybe they've filed for bankruptcy or they've closed their business. The write-off entry is going to take it out of the allowance account. So you're going to debit the allowance account and you're going to credit, I'm going to abbreviate here, accounts receivable. Now, the interesting thing about this and the reason we follow the allowance method is that these are actually both asset accounts. So if we had estimated that $2,000 was uncollectible and we actually had to write off $3,000, we took it out of how much we thought we weren't going to collect, and then we also wrote it off the client's account, that's okay. This journal entry right here is going to increase one asset. This one right here, it's a contra asset, but it's still an asset, and it's going to decrease another asset. So the effect of a write-off is actually not going to change anything on our financial position if we follow the allowance method. If we do not follow the allowance method, what you're going to see is that there's no allowance account used. So anytime you decide to write something off, you're going to debit bad debt expense and you're going to credit accounts receivable. That actually violates the matching principle because that write-off entry could be done anytime. It could be 10 years after the initial revenue. But this method, the allowance method, makes an adjustment every single month, quarter, or year to match up this expense with the revenue that was generated for that period. So if you record a bad debt expense debited and credit to the allowance, it's going to, in that period, decrease your equity and decrease your assets. Then when you have to write something off, it's not going to change anything on your accounting equation. It's again an asset exchange, or one asset increasing, one asset decreasing. The direct write-off method is just one journal entry, and the timing of it is the major difference between the two methods, the timing of that bad debt expense being recorded. The only other thing I want to mention in this video is this should always have a credit balance. So if you're working on your homework and it said there was a debit balance in that account, which sometimes happens because you're estimating how much goes in there, if it said it already had a debit balance, you would know that was on the left side. So if it had $100 in there in that allowance, but you wanted the balance to end up being, let's say you wanted the balance to end up being $1,200, you would actually have to put an entry for $1,300 on the credit side when you do your adjustment, because you underestimated last year. You're going to have to make up for that by putting more in this year. If there was already a credit balance in there, then you would do a smaller adjusting entry. If there was already $500 in there and you wanted the balance to end up being $1,200, that's what you estimated it to be, you would only have to add $700. So I'll make a few notes on that, but if you have any questions, please contact me anytime.